As I introduced this concept of balance of payments of a country in the last video, I defined it very casually as a sort of a country's bank statement trying to record the inflows and outflows of international currency. But now we want to formalize our understanding of this balance of payments, and the way we are going to do that is by first of all looking at the structure of the balance of payments account. That is, we want to understand the different sections and subsections or the different components of a country's BOP. And then more importantly, we want to understand the specific types of international transactions that are recorded within each of the different parts of the BOP. So that's the goal of this video, and let me start now with the structure first of all. And let me remind you that I mentioned in the last video about the structure that the countries, they are required by international standards and requirements to publish this balance of payments account according to a very set, standardized, globally recognized format. And that format, first of all, requires countries to divide their balance of payments into the two main sections of the current account and the financial account. And then within the current account, you have three subsections known as the trade in goods and services, the incomes section, and finally the current transfers section. And then similarly within the financial account, you also have subsections, namely the foreign investments part, the international loans, the savings deposits, and lastly the FX reserves of the central bank. So these four constitute the financial account. These three together constitute the current account of a country's balance of payments. So this is the formal internationally required structure, and therefore you need to remember all the names of these different sections and different parts. But now let me move on and explain the type of international transactions that are recorded within each of these different parts of the BOP. So I will start with the trade in goods and services and one by one take you through all of these. Now, trade in goods and services part of the current account. Trade, remember, simply means when the country either exports goods, sells goods to other countries, or imports goods, that is, buy goods from other countries. Now, if you are exporting good, and think of a country like Pakistan, if Pakistan is exporting good, it means Pakistan as a country sells goods to other countries. So of course money will flow in because you will receive a payment for these exports, and we record the total amount of, we say, export earnings, or simply the total amount of money that flows in because of exports of goods and services. We record that as a positive value over here in the trade in goods and services part. And then within this part, we also record the total amount of import spending. Importing, remember, means you are buying goods from other countries, so you will have to pay for it. Money will flow out, and we record the total amount of money flowing out because of all the imports that occur in that year as a minus amount over here. Now, of course, it will be a plus dollar amount as far as export earnings are concerned, and a minus dollar amount as far as imports are concerned. That is, all of these international money flows, as I again mentioned in the last video, they are always recorded in the international currency of the US dollar. And then the next thing that you need to know, which we will focus upon in the next few videos, is the trade balance that you can get by adding all the export earnings with the import spendings. The answer is what is known as the trade balance of the country in goods and services. Now, this trade balance, if it is positive, it means net there are more export earnings, so we say the country is experiencing a trade surplus. And if this trade balance gives you an answer which is negative, that means that more money is flowing out for imports, and we say the country has a trade deficit. So again, those are some of the basics that you need to know and then remember. Then there's one other very boring detail, but you need to know that related to this trade in goods and services, and I'll explain that to you now, and then I will move on to the explanation of what goes on in the incomes part. Now, that boring detail relates to this difference between goods and services. because sometimes what some countries do is that they record the exports of goods only, and then separately they record the export of services, and similarly they record the imports of goods only, and separately they record the import of services, or I should say the earnings because of the imports of services. And the main difference between good and service, remember your basics. Goods are tangible physical things such as shoes and clothes and cars that you can see, that you can physically touch. Whereas services are the sort of intangible things like medical services or legal services. So you visit a doctor, you purchase a service, medical service, but you can't see that medical service, you can't physically touch it. And keeping that difference in mind, what you need to remember is that if a country is just showing you the exports and imports of goods, then the balance that you will calculate the trade balance in goods only, that is given a fancy name of visible trade balance, since you are just dealing with the visible goods. Whereas if you have the exports and imports of services and then you calculate your trade balance in services only, that is given the fancy name of invisible trade balance. Invisible referring to the fact that we are just considering services which are invisible. So the A-level examiner loves to ask you questions where he wants to make sure that you know this difference between visible and invisible trade balance. So that is why this is important to know. But otherwise, for all the other things that we will be understanding, it is just just remember the overall important idea. The trades part, it is just dealing with the money flows due to exports and imports of goods and services. Then let us move on to the next part of the current account, which is known as income section, or sometimes international incomes. And what we record within this income section of the current account are the international flows of rents, profits, dividends, and you can say interest. So all of these, rents, profits, dividend, and interest, they are forms of incomes. And within this income section of the current account, we record the international flows of these different types of incomes. So rents, profit, dividends, interest, sometimes a country like Pakistan will receive them from other countries, and the total amount of these incomes received from other countries in a year will be recorded as a plus, signifying that that will create, of course, an inflow of money into the country. Whereas the total amount of rents, profits, dividends, and interests, different types of incomes that flow out or we say paid by Pakistan, meaning they move out of Pakistan, they are recorded as a minus, reflecting that they will of course create an outflow of international currency moving out of the country. Now some of you of course may be wondering that why would rents, profits, dividends, and interest, all these different incomes, why would they flow from one country to another country? So why would, in the year of 2020 where we are constructing this POP of Pakistan, why would rents, interest, dividends, and so on and so forth, why would they flow into Pakistan? Well, the reason is that in some previous years, any year prior to 2020, some Pakistani individual may have had invested in some other country. So maybe he would have bought a flat in some other country or a piece of property. Maybe a Pakistani may have had invested in New York Stock Exchange prior to 2020. And similarly, the government of Pakistan in some previous year may have had given a loan to some other country. And once you make these investments or give these international loans to other countries or invest in other countries, then in all the future years, you would expect some rent or some dividends or some interest to flow back. And it is therefore these rents, profits, dividends, and interests that we record here in the balance of payments. Remember, these are the incomes, international incomes, that flow in or out of the country because of investments made in the past years, because of loans given or taken in the past years. So on all these investments and loans that Pakistan has made or given in other countries, they will receive rents, profits, dividends, which will be recorded as an inflow and therefore a plus. Whereas in the past years, prior to 2020, Some foreign countries may have given a loan to Pakistan. Some foreigners may have invested in Karachi Stock Exchange, and therefore every year some dividends, some interest rate that we have to pay on loans that we had taken will flow out of Pakistan. And all of these incomes, we simply say paid meaning flown out of Pakistan, moving out of Pakistan. They are recorded as a minus or an outflow. And then the next section is the current transfers section. This is also sometimes known as the unilateral transfers section. Now within this section, we again record the flows of incomes, but very special types of incomes. Because these are the incomes which we say are unilateral income flows, in the sense that these incomes move from one country to another country, but not because there was some previous investment or some previous loan activity between the two countries. These current transfers, here we record those incomes that flow from one country to another, you can say, without any good economic reason. And the most common reason why income would just flow out of Pakistan or into Pakistan without any good economic reason, without there being any previous investment or loan, the main reason for that is what is known as remittances that flow internationally between countries. And let me explain what is a remittance. You need to know that. And let me just explain that through a simple example. So just assume that there is a Pakistani person who moves and settles in, let's say, UK or Saudi Arabia or US, any country other than Pakistan. And then, let's say after every 1 month, 1 month's time, he sends some money back to his family or friends back home in Pakistan. Now this is what is known as a remittance. People working in other countries when they send money back home. Now in this instance, this is where we are saying that, look, this is sort of a unilateral transfer of income into Pakistan. Somebody is sending money to Pakistan without there being any good economic reason. He's not sending money because, parents invested in him. He's just earning money and he's just sending some of it back to help family or friends. So these remittances are the main example of these unilateral income transfers that are recorded within this section. And when Pakistan receives remittances, so let me write it over here, when remittances are received, that will of course create an inflow, so we record it as a plus. Whereas sometimes Pakistan will also pay remittances, or remittances you can say will move out of Pakistan. Just think of a Chinese guy working here in Pakistan and then he sends money back home to family in China every month. So this is again a remittance, but as far as Pakistan is concerned, this time it is remittance paid out. So we record it as a minus, telling us that this is going to create an outflow of money. And that pretty much completes your current account part of your balance of payments. And you can look at the balance of incomes over here. If you just add the inflows, outflows, you can also look at the balance of current transfers if you just add the inflows, outflows within this section. But we will be focusing on the trade balance and then the overall balance of the entire current account, which would simply mean the current account balance. Let me write it down over here. So the current account balance. The current account balance is the net answer that you get when you add all the inflows and outflows that occur within these three subsections of the current account. So we can also say that the current account balance will be equal to the balance of trade plus the balance of incomes plus the balance of the current transfers part. Again, plus would mean that overall the current account is in a surplus, minus would mean that the current account is in a deficit. Now we will be talking about these current account balances and specifically these current account deficits in a lot of detail as we proceed through this section. But before we go into all of that detail, at this point, I want you to ensure that you can first of all remember the basics of the current account, the three sections that it is composed of, and the sort of international transactions that go on within each of these different sections. And I would recommend that here at this point, you just go and have a look at the MCQ bank of this section on balance of payments and try the first 10 questions. Those first 10 MCQs, they test very directly your basic knowledge of these basics of the current account. So it will be a good way of looking at how the examiner is going to test you on these things that we have just learned. And of course, it will also, more importantly, allow you to revise and reinforce the things, the basics of the current account that we have just learned. And once you are done with those MCQs, then you can proceed to the next video of this section, where I'm going to explain to you in the next video the sort of international transaction flows that take place or are recorded in these 4 subsections of the financial account. And with that, in the next video, we will complete our full roundup of the structure of the entire balance of payments, and we will take things on from there.